Let's talk about number 2, risk management. There's how it breaks down. It's often overlooked and misunderstood. This is probably the most misunderstood aspect of risk management, because 9 out of 10 traders say, I get it, I know what it is, I know how to use it. But if I ask them, but do you really? And I ask them a few questions, you start to pick holes apart that end up bleeding out the account. Now let's talk about it. Okay? Why bother managing risk at all? This is why. If you have a $10,000 account and you're starting your balance and you cap your losses to 2% per trade, I realize it's only $200. However, $200 is not the amount of money you can only invest. You're going to say, what kind of stock could I buy $200? That right there is sign number 1 that you might be misinterpreting money management. It doesn't mean you can only put $200 to work. It means you could only risk that much. You can put $1 million to work as long as you lose only $200 from that investment. It's a loss of capital that's equivalent to $200, more than enough. All right. And then here's a comparison versus a 10% loss. Now look at this. If you lose 3 consecutive trades, you have 9,400 in your account still with this 2% loss method versus 7,200 of your 10% method. If you do 10 consecutive trades and you lose, you're down 18%, keeping your risk at 2% per trade versus down 70 or 65% at 10% loss per trade. That means you've lost 65 of your account. You have $3,486 to recover with versus $8,000 keeping it at 2%. All right, this is why I want to ask you how many trades it take to lose 50% of your account at 2%. It's not actually 25 because you lose less and less because there's less of a balance. All right, that's how the math works. Now, I don't know if this is a revelation to anybody, but it's good to see these stats because here's the tough part. If you have an account worth $10,000 and you drop 50% of your account balance, what are you left with? $5,000. What percentage return do you need to make to get back to 10,000? 50%? No, 50% is only 7,500. You got to double. That's why the math stinks. The math is not your friend in the market. It's not your friend. The math will laugh at you. It'll be saying, 50%. You wish, pal, you got to double up. That psychology now tells you, all right, I got to increase my risk. You increase your risk, you're shifting further to the guy on the right that blew out his account to begin with. That's how the start is the most important thing. How you start is very important, and there's a very high correlation on if you start bad, you're probably not going to continue in the industry. My whole goal is to stop you from starting bad. All right? Why manage risk? This is why. And this is the math we talked about. Gain required to make up for a loss. When you lose 10%, you can make it back with 11%. When you lose 30, you can make it back with 43% gain. But this is where you start to really lose it. You lose 50%, 100. You lose 60%, 150. If you lose 80% or more of your account, you got to 4 times your account to get it back, just to be at break even. All right, that's why the start is very important. All right, this is what you want to include in your strategy when you're creating your entry criteria. All right, or sorry, your risk management criteria. Very important. I can't tell you how many people have a risk management plan without even addressing these kind of things. Okay, first of all, how much of your account will you risk on each trade? Put a percentage on there. You want to put 5%? That's okay with me. Just know the risk. You want to take 10% per trade? Go for it. You better not have a 10 trade stretch of losses because you're screwed. All right? If you have 5 losses, you just lost half your account balance. You better be okay with that if you're going at 10%. All right? It's fine. If you are willing to take the risk, no one is responsible but yourself. For me, it depends. Some days I'll take more, some days I'll take less. I don't have to take 2% of my account balance because I don't need to at that point. All right? It'd be too astronomical to dump that inside of a equity market that's so slow. I mean, I don't have $5 million, but, you know. All right, what's your reward to risk ratio? Not $5 million in the market at any given time. That's nuts. All right, with small amount, you control big position in futures. So what's your percentage? I'd say maximum should be 3. Otherwise, sign off on it. You're good to go. What's your risk to reward ratio? That is for every dollar that you risk, how much you need to make on each trade. All right, I'd recommend 2 to 1. I'd recommend making $2 for every one, but at the very least, try to make $1.50 for every dollar that you risk. Any lower than that, you're going to get yourself in trouble, and I'll show you why statistically in a moment. All right, so my My stops to take profits are 1.5, actually mine's 1.6 to 1. All right. When will you move your stop loss to break even? And when will you trail above that level? This starts to kind of get into the exit strategy, but the most important part you should answer this question is right there. When will you trail your stop loss to break even? Because remember, if you buy a stock, what is the percentage that you're right and wrong? Just assuming all probabilities are equally distributed. What's the percentage of you being right if you buy a stock? What do you think it is? Some people say 50%, others will say 33%. All right, the right answer is 33% because the 50% assumes it's going to go up or down, but many stocks don't go anywhere. Just pull up a chart in the summer of the last couple of weeks. All right, the question is, when are you going to trail your stop to break even or to reduce risk? Are you going to take it at 1/3 and convert it to a half trade and manage risk, or are you going to let it sit there until your stop is hit? You need to know that. I can't answer that for you. What time frame are you trading on? If you're on a 1 hour chart, maybe you can trail earlier, right? If you're on a day trade chart and you're looking at a 1 minute chart and you sat there for 3 hours, it's probably time to get out. If you're sitting on a 1 hour chart and it's been 60 hours, it's probably time to get out. If you're on a daily chart, you might not get stopped out based on time. All right. So ask yourself, when will you stop? When will you move your stop when the trade goes in your favor? When will you get out if time passes? When will you cut your risk? And then the next thing I want you to set, this is very important. What's going to be your maximum allowable daily, weekly, and monthly loss? I'll tell you why this is important. Daily, maybe you say 6% of your account. So whatever that is, you could do it as a dollar or as a percentage. Weekly, you could say 8%. Monthly, 10% drawdown maximum. Jason interrupts the webinar to ask when the webinar will be uploaded. Jason, I'll let you know in a bit. I don't know how I'm going to organize it yet. I might just throw it on YouTube. Monthly, and if you want as well, annual, but I wouldn't recommend annual. I'll just go with these numbers because I'll tell you why. If you have 6% and you go Monday, Tuesday, Wednesday, and you blow out those trades, all right, now you only have 2 days left with 1 day worth of loss. All right. Now, if you go Monday, Tuesday, Wednesday, Thursday, and Friday, and you lose all these days consecutively, you're done for the month. So the way these maximum drawdowns will help limit you is to reduce your trading time, and it would actually increase your patience and allow you to be more selective, choosing the right opportunities. Just don't just throw yourself at the market mercilessly. Have strategy behind it. It'll force you to be strategic and be patient. Today, for example, I did about 15 trades, made about 790 or something. I'd have to double check my account. I could check it later at the end of the webinar, but almost $1,000 on 15 trades. But it wasn't like that at the beginning. I was down a little bit. Then I made it back, then bounced back and forth. Never hit the stop out. If I hit the stop out for the day, I'm done. And I've been in the room with the guys where I told them, I'm $2 away from getting stopped out and I have to leave. I can't trade anymore. This thing is real, guys. This is a business. This is real. This is not a game. You have a boss. You have a plan. The boss is you. The plan is yours. You have to own your mistakes. Nobody's going to come up to you when you're successful as a trader and say, I taught you how to trade. I don't care if you learned it at TRADEPRO Academy. I would never come up to you and say, I'm the reason that you did this. You're the reason that you did this. So when you're losing, don't look to point fingers. Look in the mirror and say, maybe it's me. Maybe I need to change what I'm doing and how I'm approaching the situation. All right. So set yourself daily, weekly, monthly losses. Guarantee you it's going to make a big, big, big difference if you can follow it. It's one thing to set it. It's another thing to follow it. All right. Let me walk you through this. How to determine position size. This is very important in trading. What determines how much money to invest in each trade? Risk, right? Not how much you want to buy. Not, hey, I want to buy 1,000 shares. What does that mean? What's 1,000 shares? So what you do is you take your capital, you multiply it by 2%, and you get something called RC, risk capital. Let me just write it with the pen. Risk capital. This is when I said, remember, $200 per trade seems like nothing, but it could be a lot. It could be a lot of money that you're investing to take that 200. So let's use an example. Let's say a company's trading at $10 a share, and you've looked at your technical analysis and your stop has to go below $8 a share. You're not putting your stop where you need to put it to lose 200. You're identifying where does a stop need to go. All right? It's very important. You're not moving the stop to the place it's going to be 2%. You're putting the stop first and then deciding how many shares to buy. That's where people get it wrong. Say, oh, it's trading at $10. You know what? $8 represents my risk capital, so I got to stop out at 8. And guess what? It goes down to 795, bounces back up, and you get frustrated because you missed a trade, but your support was at 790. So you should have never had your stop there. You messed up. You forced it. So what you want to do is, where should the stop go? It should go at $8. Okay, good. Based on technicals, how much is the risk premium? $2 per share. All right. I have $200 to risk, $2 per share of risk premium. How much could I buy? I could actually buy 100 shares. If this company's trading for $20, suddenly it's $2,000 of your 10K. It's not just $200. It's where the mistake is made very often. All right, the capital you're going to use is going to be much higher, but the 200 represents how much could you lose. If you plan to buy something and hold it until it dies, then yeah, fine, $200. But you don't need to wait that long. You can cut your risk way sooner. You're kind of getting in, getting out. All right, that's how that works. Does that make sense? That's what you want to put in your risk management strategy. Here's mine. I'll show it to you. This is my live risk management strategy that I use every day. All right. Subscribers here that are in the room, they know my 5/8 strategy. You guys know it, right? Would you say I stick to it pretty regularly? On the SPOOs on S&P 500, yeah, sometimes I'll bump it a notch, 1 or 2 ticks here and there based on levels, but for the most part, I stick to this thing. All right, and here's the situation. This is the way to read this is 10 trades a day. That's kind of what I go for myself because I day trade. All right, and I swing trade, but predominantly day trade. The win and lose is how many trades of 10 you win or lose. So look at this. If I win 4 trades and lose 6 trades, I still make $25 with one contract in the day. All right, one contract takes $500 of margin with AMP Futures, your partner broker. So this is what I'm saying. You don't need a lot of capital. Now look at this. If you want to tell yourself, I'm a winner, I'm going to go for 70% win rate. If you win 7 and lose 3 trades out of 10, you're making $500 with a $500 account balance. Brain explodes. And then you're going to say, George, how's that possible? All right, how is it possible that somebody can make 100% return every day? All right. But listen up. Remember, the 2%, your risk has to be part of the total balance. So anything's possible. If you're planning to go 10-0, if you're planning to be a superstar trader, then you're doing it wrong. You shouldn't try to win trades. You should try to win money. Then you're going to make $1,000 off 500. But the key here is what? Here's an example with 2 lots. This is trading 1 contract. 2 contracts is $1,000 margin on the S&P 500 futures. If you're risking 5 ticks and taking profit on 8, that's my strategy. I call it the 5/8 strategy. I'm very creative. And there's a secret meaning behind it. There isn't. Risk 5 ticks, take 8. All right, so if you're doing 2 lots and you go 50%, you make $375 with $1,000. If you could just win half the trades you take, the message here is you don't have to be right. All right, right is not what you're looking to be. You don't have to be right. You just have to manage your risk and be selective of your trades. You don't have to know where the market's going. Forget direction. Doesn't matter. Doesn't matter. Direction doesn't matter. You give me a trade, I'll get in and I'll get out on my own way, and I'll probably still scratch to maybe be slightly negative or slightly positive, depending on the number of trades, because it's risk management. That's all that's at play here. That's all. All right, if you go 6 and 4, which is completely manageable, $700 on 2 lots. That's my risk management grid. You got to create your own. All right, take a hypothetical 10 trades. Take what your average stop is, your average profit, get this grid in front of you. It's printed in front of me below my monitors right now because I always glance down while I trade at it to queue up my trade. All right. So let me ask you a question. If I see S&P 500 futures looking like this and I buy up here and my, let's say 5 ticks of stop loss is down here, but really it should go down here, what do? Do I go 5 ticks and make it 8 instead? What do you guys, the guys that are in the room that are here today, what do I do usually? I usually leave it. And I tell myself, if I'm buying tops for a breakout in a slow market, that's what I deserve if it comes down. I deserve to get my butt kicked 5 ticks lower. What am I thinking buying it up here? Sometimes I'll take the risk, other times I won't, but my risk doesn't increase. It decreases, I'll never increase my risk. If I need to have 8 ticks, chances are I should just buy it 3 ticks lower. Why? If it needs to be down here for 8 ticks and my strategy is 5, 8 minus 5 is 3 ticks lower. That's why I put my buy order. Now that's a good risk trade because you got your level and you got your lower entry. And if you miss it and it doesn't drop down there, who cares? How much money do you lose when you miss a trade? 0. What's your goal? To manage risk. Does that look like risk was managed? Yes, next. Simple. You got to be methodical with this stuff. You can't care about anything but risk. All right. So like I said, here it is. I'm risking 5 ticks to make 8 for my S&P 500 future strategy. Or I do 12 and 18. NASI, I don't know. Sometimes it works out to be about 1.5 to 1. NASDAQ depends on the day ranges. Sometimes you got to adjust it too. All right. So if I'm getting a reward of 8 to 5, I'm 1.6 to 1. My reward is $1.6 for every $1 that I risk. Therefore, this is how you do your analysis. Risk divided by risk plus target equals the percentage of winning trades. I got to win 38% of the time to make money. The last week, I've been making money, but it's been a bit of a hustle. I'm going to be honest with you. All right, I've probably been winning about 38%. Heck, I wouldn't be surprised if I'm only 30%, but I'm only getting away because of risk management. All right, those days come. You can't be worried. People who are worried about losing days consecutively are the ones that aren't confident in their strategy. Your strategy has to be able to handle that. All right, imagine being a surgeon and being right only 38% of the time. You go to a surgery and they say, I tell you what, I'm going to cut you open, but there's a 38% chance you're going to live. So I might cut the wrong vein or something. I'm going to go in there. I'm going to go with 38%. All right, that's your chance. Were you going to let them do it? I'll say goodbye. I'm going to just take my chance living for however long I get. No thanks. But you could do that. So thank God I'm a trader because I'm about 38% is what I need to break even. All right, I'm just being honest here. That's what you need. If you did that at your job, if you did 38% of the quality of the work that you do, do you think you'd still be around? That's the thing. Traders come into this business expecting the having to be right because that's what they're taught all their life. You have to be right. You got to go to school. You got to get straight A's. None of that matters. All you have to do is manage risk.